Good afternoon, everyone. Thank you for coming in to Golden Home Real Estate, um, powered by eXp Realty LLC. And I have with me again my friend and co-associate, Shelly Kenny Stevenson. I might have said that backwards, but
That's okay.
she is here to talk with us about some interesting topics. And I am going to turn it over to Shelly. She's going to talk about the turbulence in real estate and different workarounds, the interest rate, and whatever her platform is. I'm on board with it today. So I'll turn it over to Shelly. Shelly, it's on you.
Oh, thank you so much, Karen, and thank you for having me here today. I really appreciate it. So before we got started, Karen and I were talking about, you know, getting through a real estate transaction is almost like being on an airplane. So Karen and I are your co-pilots, and our job is to get you to your destination. There's a bunch of flight crews and ground crews and people in the tower that are going to help us get there, and we rely on them in certain circumstances, but you're really relying on us to get you from point A to point B. That is not owning your home to being in that home and being successful and happy. And just like on an airplane, we may see some turbulence in the water. We may say, hey, there's some turbulence up ahead, or I even sometimes say a bump in the road, and we'll give advice. We need to prepare for that in this way. You need to understand the documentation that will be involved, or you need to understand the rate situation that is involved. And just like on an airplane, you're going to buckle your seatbelt, you're going to put your tray table up and just follow those instructions and trust in your co-pilots to get you there. That's how we're going to navigate through this with you as well. And one of the big issues that kind of is on everyone's mind these days is the interest rate situation. For a long time, we got really used to having super low interest rates, 2%, 3%, even 4%, seemed high at some points. And now that has completely changed. And a lot of it has changed because of the US government monetary policy. The Fed isn't buying mortgage-backed securities. So we've got a glut in the market, and banks and Wall Street just don't have the money to buy those that they once did. And so they're expecting a higher return on their dollar. So a lot of people are saying, well, maybe I should just wait until rates go back down. But really, to those historic lows, the 2 and 3% that we enjoyed for so long, really aren't there in the foreseeable future. Of course, I can't really predict the future, and neither can Karen. If we could, then we would have used our crystal ball to figure all that out and be retired on a beach somewhere together, laughing and drinking mimosas, right, Karen? But in the meantime, what we need to do is just understand that, yes, rates are higher than they were. Let's make sure that we work with you in ways to mitigate that. Perhaps we can buy that rate down, which is paying some discount points to get the lower rate, making sure that you're going to get return on that investment. And that can either be a permanent buy down or a temporary buy down. And that means it could be lower for the whole term of the loan, or it could be lower for the first year or two while you're waiting to see what rates do. And then if rates do go down, whether you've bought your interest rate down or not, we can always do a refinance. And many lenders, myself, my lender included, are doing some special deals where within the next 3 to 5 years, if rates really do this huge correction and you want to refinance and get that lower rate, we'll give you discounts on some of those fees to make sure that you're not paying duplicative closing costs. As much as we can, mitigate those as much as we can. So those are kind of some of the things to think about. Real estate, though, you may have heard that prices have dropped a little bit, and you hear that on the news. That's not true of every place. And I know, Karen, you could speak to that better than I can. But and you may hear on the news, oh, interest rates are down again. But in reality, when you look at it, down again maybe means 1/8 of a point or 1/4 of a point sometimes. So that's really not a reason to put off your home buying journey. Invest in yourself and know that there are ways to mitigate those higher rate costs that are out there right now. Hi, Karen, I think you're muted.
Thank you. I was. Can you hear me now?
I can.
Okay, I have a question. So I know the answer to this, but a lot of the listeners may not. So can you explain what buying down an interest rate entails? Like, how do they do that? Help them
Absolutely.
understand what that means.
So when you get a rate quote from a lender, and just for example, they'll say the rate quote today is 6%. And you say, does that come with discount points? And they say no. And then you ask, well, what would it cost to buy the rate down to 5.5? That means you're willing to pay more at closing, and that's a percentage of your loan amount. So you're willing to pay more at closing to get that rate from 6% to 6.5. Typically, what you'll see, and this isn't guaranteed and it isn't always the case, but typically 1% of your loan amount additionally paid at closing, so you're paying more out of pocket at closing, will lower your interest rate by 1/4 point. So if it's at 6 with no discount points, then it would be 5.75 with 1 discount point. And the important thing to remember is, how much is that going to lower your payment? It may lower your payment a lot if you're buying a 3, 4, 500,000 house or more. It may not lower your payment very much if you're buying a $200,000 house. So make sure that you and your lender do the math and make sure that 1% that you're paying out of pocket up front, you're going to have enough monthly savings in that payment going forward so that you recapture that investment well before you ever think that you might be ready to sell or move or refinance that home.
Thank you for explaining that, Shelley, because I mentioned to a lot of my potential buyers about rate buy down, and they don't really understand or didn't understand what that entails. So this helps to, explain that to people that really don't know. Um, so you talked about prices coming down, but it's not in North Texas. We're like the
No.
second highest market in the United States, second to, I think, Nashville, Tennessee is what I think is the first place, believe it or not, that everybody's moving to. And it probably has to do with affordability as well. I've never been there, but I'm not really sure. But I know the Houston market, and I do real estate in Houston as well. Their market's coming down. But the Dallas market, I haven't noticed too much of that yet.
Yeah, and it is very market specific, and that's why I kind of wanted you to talk on that, because I've seen it in markets across the country a little bit as well. But you realize that the news paints everybody with the same brush, right? And so that's depending on the market you're in, you may or might not see any price relief.
Right. Okay, so we touched before on the fact that I think it's better to I prefer pre-approval
Oh,
versus
yes.
pre-qualification. And just, we have a few more minutes. Just elaborate on that quickly because I try to push pre-approval. I would rather wait and make sure that that person was good to go than to do all the negotiating up front and then they're not. So just kind of explain the difference, please.
Absolutely. So pre-approval, again, means that you've submitted your supporting documents like pay stubs and W-2s and tax returns to your lender. And they've actually had an underwriter double check that loan officer's calculations and given them a list of things, hey, you're going to need if they decide to proceed, and you've checked those boxes. Pre-qualification may be based solely on the information that you put on your application without any supporting documents at all. And sometimes that's okay, but sometimes that leaves us open to what I call a who'da thunk it, right? We get your pay stub back and suddenly we realize that maybe you have a garnishment for some old child support that you hadn't even thought about, and that could throw a monkey wrench in. So what Karen is saying is that, yes, you can get pre-qualified with your loan officer, and then she can know your price range and start sending you, ideas that are in your price range. But while she's doing that, you and I, the lender and the client, need to get together and make sure we've got all those documents in, we've double checked everything, and we've had the underwriter put a set of eyes on it too. Now, that doesn't mean that we're not going to come back and ask you for something later. It just means that we're avoiding as many of those who'da thunkets as you could possibly avoid at that point in the process.
I appreciate your mentioning that because I get clients, sometimes I'll send them for pre-qualification and they think that's the red light, the green light to go. And then they kind of fall off with following up with you or any lender until we get closer to the end. And sometimes it falls apart at the table because that's pre-qualification is just a snapshot. And that's all it really is, income based, right? Based on their income.
Exactly. It's basically your income and your credit. And like I said, if you haven't given the lender any documentation, that's based only on what you put in there. And there's nothing wrong with it. I mean, as a consumer, you're putting in that you make $5,000 a month, let's say, and the lender gets it and you're actually making $48.50 a month. That may not seem like a big deal. It's just a rounded figure, but that $150 a month could equal the difference between getting into the house you want and not, based on the sheer fact that homeowners insurance can be $150 a month. So that has a play into it as well.
Shelley,
Yes, ma'am.
taxes, property taxes, does that have a play into it as well?
Oh, absolutely. So property taxes are considered part of your monthly housing expense, whether you pay them through the mortgage or you pay them yourself. The lender will always count 1/12 of your annual property taxes as your monthly housing expense. And we know in Texas and a lot of other places, those taxes are based on the county's appraised value of your property, or in the case of new construction where the county hasn't appraised it, the sales price. And those are percentages. And in Texas, I have seen percentages range from 1.5% to 3.5%. So you can imagine that divided over 12 months could significantly raise, or, that qualifying housing expense every month. And again, that's whether or not you're paying those taxes through your mortgage or on your own at the end of the year.
And one other thing, Shelley, had to do with taxes. Oh, can you explain how, briefly, when it's a new construction, how the taxes, they don't really know how much those taxes are going to be? Do you have any information?
Yes, absolutely. And I'll try to be quick because I know we're at the end. So every year between February and April, the county goes out and assesses the property based on what they can see from the outside and decides how much your value will be worth to the county that they're going to tax you on. New construction, if they get out there early in the year and there's nothing on the lot, or there's only a foundation, they're not going to assess, they're going to assess it as unimproved. And then later, whenever they assess it the next year, they're going to see the house and your taxes are going to go up. The tricky part, Karen, is right there in the first of the year. Let's say you're buying a house in January, February, March, like we are right now. We just finished March, and that house is built, but the assessor hasn't come out yet. Your bill at the end of the year will be on improved, even though at the time you close, it still shows unimproved, because they're going to play catch up there. And those taxes at the end of the year are going to be much higher. And you're muted again, darling.
Thank you for explaining that. I've had a few clients that bought new construction homes and then got shocked 6, 8 months later on the tax bill.
Absolutely. Absolutely.
Now their
And you
house
always
note is
have
a
the
lot higher.
option.
Oh,
You have the option of escrowing your taxes. That means paying it through your mortgage and paying a lump sum at closing on what we anticipate the bill will be. That doesn't mean the builder is going to reimburse you on that anticipated amount. So that's something you need to talk to the title company about. If it comes back assessed higher, how do you go back to the builder and get their portion of those increased taxes to cover what they didn't reimburse you for?
See, I didn't know they could do that. Thank you I learn every time we do a Zoom, I learn something new myself. So I appreciate it. I appreciate it very much. So we're just doing a short today because I was having trouble getting the long 45-minute to an hour Zooms on YouTube. I can get them on Facebook, which is kind of strange, but I was having trouble loading them on YouTube. So I've cut it down to just doing some shorts, brief little things that people don't know about or need to be reminded about, and even real estate agents. Like, again, I learned something new myself today. So I appreciate
And
your
I do,
taking this.
I do every time I speak to you too, Karen. Thank you.
Yes, I appreciate your taking the time out of your busy schedule. And everybody, I will put Shelly's information in the link below. She is my preferred lender. You can use your own, no problem. But she is the preferred lender. So if you come to me without being pre-qualified, I'm going to send you to Shelly. We tag team together. We work great together. And so I'm going to keep that going. So I appreciate everybody watching this. Her information and my information will be tagged below, and come back again. We'll do this again in a couple of weeks, maybe a month. So we appreciate your time as well. Thank you for joining. One moment, Shelley.
Thank you.